Indicators do not work. They do not work in trading, and I've spent years learning how to trade. It took me years longer than it needs to be, and I wasted so much time on useless indicators that did absolutely nothing for me, right? After years of trading, I literally do not even use 90% of what I learned, and indicators held me back so long, and it took me 2 years to become a profitable trader, and that's short compared to most people. I can honestly say indicators are a complete waste of time. In this video, I'm going to explain why they're a waste of time and what actually works instead. Okay, so why do indicators not work? There's one very simple reason why they do not work. It's because there's a time lag. Now, what do I mean by time lag? An indicator, by its very nature, by the way it is, it only plots data from the past, right? It only plots data from the past. And what that means as a trader is, in hindsight, it looks really good, right? You know, right here we have a simple moving average. And this works for, all indicators. The exact same principle applies, including VWAP, right? Including VWAP, because I spent literally a year studying VWAP. The exact same principle applies. In hindsight, it looks good. It looks like, oh, if I bought when price went above this, I would have made money. Okay, but your job as a trader is not to look at price in hindsight and say it looks good. Your job as a trader is to predict where price is going to go, right? That is your job as a trader. And if anyone says otherwise, if anyone says your job as a trader is not to predict price, it's to manage risk, they don't know what they're talking about. Your job as a trader is to get onto the charts, and based on your technical analysis, you've got to predict, is price bullish? Is it going to do something like this? Right? Is it going to do something like this? Is it going to be bearish? Like that? Or the third option, is it going to consolidate? Right? This is your job as a trader. When you get onto the charts, you've got to use all your technical analysis to predict what is price likely to do. Is it likely to be bullish? Is it likely to be bearish? Or is it likely to consolidate? Right? Those are the three options that you always have. Now, the problem with indicators is it shows you the past, and the past is irrelevant in predicting the future. Right? That's so important. The last 9 candlesticks has no weighting whatsoever on smart money, on those who have billions of dollars to move the market. It has absolutely no weighting what they do at all. Right? Do you really think they're looking at, a simple moving average or even the VWAP, right? And they think, oh, well, price must bounce off this line or we're going to buy it. It's not because of any of that. It's not because of any of that. And with indicators, you have a huge time lag. And the most important thing about trading is you need to predict what's about to happen next, right? What's going to happen next. And with indicators, it shows you the past. And we don't care about the past. We care about the future. And that is why indicators fail. They can't tell you what price is likely to do, right? And there's only one key reason that price moves. And if there's something you take away from this video, let it be this. Price only moves for liquidity, right? That's it. It does not move for indicators. It does not move for VWAP. It does not move for, volume profile. Because I spent literally a year studying volume, VWAP. It does not move for any of that. It does not move for any of that. It simply moves for liquidity, which is stop loss orders on the higher time frames. Now, why does it move for stop loss orders on the higher time frames? Now, the reason why price moves for stop loss orders on the higher time frames is because there's an entity that actually moves the market, right? Like, the only way you're going to move the S&P 500, right, is if you have billions of dollars, not one futures contract. You need billions of dollars to even move like it by a few flipping handles in this case, right? You need billions of dollars, and those who have billions of dollars, they can only operate on the higher time frame. They can't get in on the 5-minute chart. They just have too much money. So they go onto the higher time frames and they target stop loss orders because they can actually get into that position, right? Smart money, if you have billions of dollars, you can't just press buy and then get into a position. There's too much money. So you need to be at a key area where there are other sellers, let's say. So if you want to buy, you need those who are selling, right? If you want to buy billions, you need those who are selling billions. And let me show you why price actually moved up, right? Let's show you why price was actually bullish in this case. So let's remove all these drawings and let's remove the indicator, right? If we zoom out, we have a key high here. So let me just go on to the 15-minute chart to make it a bit more clearer, right? If we zoom out, let's make it clearer like this, right? Right here was a bearish move, right? There was a strong bearish move. Lots of people were shorting. Think about support and resistance. If you were shorting in this move, where would you put your stop loss? Right, you'd put it at this high here, right? This is what all the textbooks tell you. So right here, people would put their stop loss orders and they would call this very good resistance, right? Remember, we all use support and resistance. Now, support and resistance is a load of crap. And if you've been trading for, maybe like 3 months, you'll figure out right away that it's a load of crap, right? Price is not bouncing up to these random lines to bounce down, right? That's not how major financial markets are moving. That's completely wrong. What's actually happening is, let me just make this clear, is there something called liquidity, which is just stop loss orders, right? Stop loss orders. And let me just make this a bit more clear, right? At this key high, let's make it all the way like that. At this key high, lots of people were shorting. Lots of people are shorting price as it goes down. They've put their stop loss here thinking it's nice and safe, right? They believe in support and resistance. They think price is just going to come up and bounce off this level. The real reason, this is so important, the real reason why price comes all the way up here is because smart money, this entity who has billions of dollars, who want to get into the position, they know there's going to be lots of buyers here, right? Because if you've shorted, think about it, if you've shorted a position, you've sold, what do you have to do to get out of your position? You're going to have to buy, right? Now, smart money who have bought all the way down here, if they want to get out of their position, if you bought something, what have you got to do? You've got to sell something. So they're going to target stop loss orders to get out of their position. Right, I hope that makes sense, because there's one thing that you need to focus on in all technical analysis, it's liquidity. Right, so if you understand this concept, you can become a profitable trader and you can get the direction right literally 90% of the time. So price in this case, it's come up, right, we've come all the way up for this key high. This key high, because there's lots of liquidity, there's lots of stop loss orders. If you struggle with the concept of liquidity and stop loss orders, just think of money. Right, think about where would there be billions of dollars in these major financial markets? It'd be at key highs and key lows. Right, and obviously the higher time frame, the more significant. But on the 15-minute chart, this is the key time of day. Absolute loads of liquidity here. So price moves up, and you see this wick here. So let's make this a bit more clearer. See this wick? You see how we poke up? We poke up right here. That right there is smart money taking out all these orders. Right, price comes up, it takes out all the stop loss orders, and then we start thinking reverse. Right, we start to consolidate a bit. The only reason price came up here was because there's lots of liquidity. Lots of stop loss orders. I'm telling you, this is how these markets move. They do not move for VWAP. They do not move for moving average, Bollinger Bands. None of that shit. None of that. I wasted so many years, right, on that stuff. It does not move because of that. It moves only for liquidity. And if you take one thing away from this video, let it be this, right? If you target key highs and key lows, there will be liquidity there, and the market will move for that. It will move for that. And if you don't believe me, literally go into your charts, get onto the 15-minute chart, the 4-hour chart, whatever you want to do, and as price moves up for key highs and key lows, see, does price actually come up and take out those highs, or does it do what support and resistance does? Does it bounce off these imaginary levels and go down? Right, I'm telling you, the moment someone explained liquidity to me, bam, just like that, instantly I was profitable. Instantly I could just predict where the market was going to go consistently. And your job as a trader is to predict where price is going to go next, right? And there are so many people in this industry who have no idea what they're talking about. They say, oh, your job as a trader is not to predict price. Like, what is the point in technical analysis then? Like, what is the point in technical analysis if you're not going to predict where price is going to go? You have to predict where price is going to go with probability, right? Not certainty, because there's, nothing is certain in these markets. But you need to have a direction, right? You need to get onto the charts. Let's get back onto the 5-minute chart, right? You need to get onto the 5-minute chart, and you've got to have, a direction for the market, right? You've got to have a bias, a thesis, if you will, right? Where price is likely to go. And then based on that, based on your knowledge of technical analysis, all you need is a simple entry pattern, right? So, right here is that key liquidity pool, right? So this is our target. We would target this, right? We're not going to wait for price to come up here, because some people are asking me this. We don't wait for price to hit the liquidity pool and then start to trade. What we do is any entry here, right? Any entry here all the way up to this liquidity pool, right? That is a high probability trade. And then once it hits this liquidity pool, we just don't trade, right? And you can see we start to reverse and consolidate. And if you really love indicators, if you just combine it with liquidity, right? So let's say you've got the liquidity here, you're bullish, you're targeting this key high, right? If you've got, anything, VWAP, right? Let's say VWAP bounced off here, or, moving average, EMA, whatever you want, you can take an entry, right? As long as you're targeting liquidity, the entry pattern does not matter, right? The entry pattern is the least important thing, and we spend so much time trying to finesse an entry pattern. You do not need it. My entry pattern is just a Fibonacci retracement, right? So my entry pattern would literally look like this, right? Those are wondering. So we've got Fibonacci. Now, Fibonacci does not move price. Let me make that very clear. Fibonacci does not move price. There's no magic in it. The real magic here is the liquidity, right? This big blue line. This is the real magic, right? I know that price is going to go for this key high because there's lots of stop loss orders. There's billions of dollars at this key high on the S&P 500, right? One of probably the most traded market, right, in the world. There's so much money at this key high. Price is going to come up and it's going to take out this high. So I have my direction, right? Let's say I'm on the charts, right, around this time. So when is this 9:30 open here, right? I'm on the, and this works for all markets, by the way, all markets, including stocks, including crypto, literally anything you can imagine, commodities too, gold. So if I'm on the charts at 9:30 a.m., let's say, right, I know price is bullish. I know we're going to go for these highs, right? I'm 90% of the way there. All I need is a simple entry pattern, right? And then all I'm going to do is I'm just going to enter at the 0.705 levels. Let me just get my Fibonacci settings, right? Again, Fibonacci, it's not the magic. The key magic here is the liquidity, but 0.705 level. This is the only level that you really need, right? This one here. We've got this. I'm going to enter at the level like this, right? I got stop loss at the low of the Fibonacci, and me personally, I just target 3 to 1, right? And this is important, right? Why am I not targeting all the way up here? Why am I not doing that? Well, there's one major reason, right? What happens is price could do this, it could come up like that, then it can consolidate, right? And imagine this is like a new fresh day, then it can come down a bit, then it could go up, and then in the next day it could take out that liquidity pool, right? That's what price could do. It could come up and it could, almost reverse on you intraday. So you don't want to target, and I always say this to my students, you don't want to target more than the 3 to 1, right? Let's be honest, if you're risking $1,000 and you make $3,000, who's going to be angry with that? Who's going to be angry with that? But just be wary, the higher the risk to reward ratio, the more likely it is to start to reverse. I know in this example we get it, but you won't always get this, right? So you don't have to target, the key liquidity pool. You just have to trade in that direction, right? That's so important. The liquidity here just gives me the direction. It just tells me I'm bullish, right? When I'm bullish, I'm literally, all I'm looking for is my entry pattern. And this is my entry pattern, right? Simple, easy entry pattern. Nobody in the world would say this is such a, a sophisticated, complex entry pattern, but I'm a profitable trader. I can make all the money in the world with this. And, for those who wonder, I do this exact thing on the 4-hour chart now because I'm too busy to be a day trader. But when I was day trader, scalper, I would do the exact same thing. The exact same thing. So what actually works in these markets is liquidity. The markets only move, these financial markets are only designed for those who have billions, right? It's not designed for me and you. It's designed for those who have billions, right? And the market will only move to accommodate their needs. And their needs is they need to get into their position and they need to get out of their position. And they can only do that at key highs and key lows where people would, be shorting and where people are going long and where people would have their stop loss orders. So what we do is we target these stop loss orders. That gives us our direction. And then any entry pattern will do. Any entry pattern will do. And I know people are going to say Fibonacci is like a indicator, like whatever, bro. Like it's a measuring tool. Do you know what I mean? But like the whole point is you targeting liquidity. You target liquidity, you get the bias, and then you use any entry pattern. If you want, if you want to use VWAP, you want to use whatever, that's fine. But make sure you're targeting key highs and key lows, right? And yeah, that's literally all you need to be a profitable trader. And if that went way over your head, then don't worry. I teach about this a lot more on the channel, and I've got a full step-by-step course literally teaching you everything you need to know about liquidity, and I give you 10 entry patterns or 10 entry models that work. And I teach you about trading psychology and even the law of attraction, right? That will actually fix your trading psychology because, yeah, no one talks about that. But anyway, there'll be a link in the description below. But other than that, make sure you like, subscribe, and leave a comment telling me what you want me to cover next. And I'll see you guys in the next video. Peace.